Hello, and welcome to our series, Tax Evasion versus Tax Avoidance, the critical legal line in the U.S. Over the next 15 chapters, we will explore one of the most misunderstood, yet fundamentally important aspects of the American financial landscape. We'll navigate the complex world of the tax code to understand the crucial difference between legally minimizing your tax bill and illegally cheating the system. Before we begin, it is essential that we start with a clear disclaimer. The information provided in this series is for educational and informational purposes only. It is not intended to be, and should not be construed as legal, financial, or tax advice. The tax code is incredibly complex and subject to change, and your individual circumstances can significantly impact your rights and obligations. Always consult with a qualified professional, such as a licensed attorney or a certified public accountant, CPA, for advice tailored to your specific situation. Our goal here is to educate, not to advise. So let's start with a simple question that every single American taxpayer has likely asked themselves at some point. How can I pay less in taxes? It's a natural and logical question. No one wants to pay more than their fair share, and the desire to keep more of your hard-earned money is universal. This very question is where our journey begins, because how you answer it can lead you down one of two very different paths. One path is perfectly legal, encouraged by the tax code itself, and practiced by millions of individuals and businesses every year. The other path is a federal crime with severe consequences, including hefty fines and potential prison time. The first path is called tax avoidance. The second is called tax evasion. On the surface, they might sound similar. Both result in the government receiving less tax revenue from you. But in the eyes of the law and the Internal Revenue Service, or IRS, they are worlds apart. The line between them is what we'll call a bright line. A clear, unambiguous distinction that separates legal behavior from criminal activity. Let's define our terms in the simplest way possible. Tax avoidance is the legal practice of arranging your financial affairs to minimize your tax liability, using the methods and strategies that Congress and the IRS have explicitly allowed within the law. Think of the tax code as a rulebook for a game. Tax avoidance is simply playing that game skillfully and strategically, using every rule to your advantage. For example, when you contribute to a 401k or a traditional IRA, you are practicing tax avoidance. You are legally deferring taxes on that income until retirement. When you claim a tax credit for installing energy-efficient windows in your home, or a deduction for student loan interest you paid, you are practicing tax avoidance. You are taking advantage of incentives the government has created to encourage certain behaviors. Tax avoidance is not a loophole in a negative sense. It is the intended functioning of the tax system. Now let's look at the other side of that bright line, tax evasion. Tax evasion is the illegal act of intentionally and willfully underpaying or failing to pay the taxes you legally owe. This isn't about using the rules to your advantage, it's about breaking them. Tax evasion involves elements of deceit, concealment, or misrepresentation. For instance, if a contractor gets paid $10,000 in cash for a job and deliberately decides not to report that income on their tax return, that is tax evasion. If a business owner creates fake invoices to claim expenses they never actually incurred, that is tax evasion. Claiming a dependent you don't actually have, hiding money in offshore accounts without proper reporting, or falsifying documents. These are all classic examples of tax evasion. The critical word that separates these two concepts is intent. The core of the legal distinction lies in the mindset and actions of the taxpayer. Tax avoidance is based on disclosing all of your information accurately, and then applying the law to that information to find savings. Tax evasion is based on hiding or falsifying that information to mislead the government. Let's use a very clear, side-by-side scenario to illustrate this. Imagine two individuals, Sarah and Tom, who both run small consulting businesses. Both want to lower their taxable income for the year. Sarah, practicing tax avoidance, sits down with her accountant. They review her finances. She learns that she can set up a SEP IRA, a retirement plan for self-employed individuals, and make a significant tax-deductible contribution. She also meticulously tracks all of her legitimate business expenses: her home office, her business mileage, software subscriptions, and client lunches. She claims every deduction she is legally entitled to. At the end of the year, she has successfully and legally lowered her tax bill. She has avoided paying more tax than was necessary. Tom, on the other hand, decides to practice tax evasion. He also wants to lower his taxable income. Instead of looking for legal deductions, he decides to underreport his income. He has several clients who pay him in cash, and he deposits that cash into a personal savings account without ever recording it in his business books. When it's time to file his taxes, he reports only the income he received via checks and bank transfers. He has willfully concealed a portion of his earnings from the IRS. Tom has crossed the bright line from avoidance to evasion. The difference is not in the outcome. Both Sarah and Tom paid less in taxes. The difference is in the method. Sarah was transparent and used the law. Tom was deceptive and broke the law. Understanding this distinction is not just an academic exercise. It is the foundation of responsible citizenship and financial management in the United States. In the chapters to come, we will delve deeper into the specifics of legal deductions and credits, explore the red flags that can trigger an IRS audit, and examine real-world court cases that have shaped the very definition of tax law. We will look at the tools the IRS uses to catch tax evaders, and discuss the severe penalties they face. To recap our first chapter, the desire to minimize your tax burden is a legitimate one. The law provides a clear pathway for doing so through tax avoidance, the strategic use of legal deductions, credits, and financial planning. However, when strategy turns into deceit, and planning turns into concealment, you cross the critical line into tax evasion, a serious federal offense. The key is intent. One follows the law, the other willfully breaks it. Thank you for joining me for this introduction. In our next chapter, we will explore the history and philosophy of the U.S. tax code to understand why these opportunities for legal tax avoidance exist in the first place. Welcome back to Tax Evasion versus Tax Avoidance, the critical legal line in the U.S. In our last chapter, we established the foundational bright line that separates legal tax avoidance from illegal tax evasion. To recap, avoidance is using the law as it is written to your advantage, while evasion is willfully breaking the law through deceit or concealment. But this raises a fundamental question. Why is the tax code so complex in the first place? Why does it seem filled with so many deductions, credits, and rules that allow for tax avoidance? The answer is that the United States tax code is designed to do far more than just collect money. It is one of the most powerful tools the government has to shape public policy and influence the behavior of individuals and businesses. Understanding this why is crucial to truly grasping the legal and ethical nature of tax avoidance. Once again, please remember that this content is for educational purposes only and does not constitute legal, financial, or tax advice. Always consult a licensed professional for guidance on your specific circumstances. At its core, the tax system is part of a social contract. Citizens and businesses pay taxes to fund the essential services that society depends on. Things like national defense, public infrastructure like roads and bridges, the court system, education, and social safety nets. The primary purpose of the tax system is, and always will be, to raise the revenue needed to keep the country running. However, over the last century, Congress has increasingly used the Internal Revenue Code as a vehicle for achieving specific economic and social goals. Think of it this way. If the government wants to encourage a particular activity, it has two main options. It can spend money directly on it, or it can offer a tax break to people who engage in that activity. Often, offering a tax break is seen as a more efficient way to achieve the goal. This is the very heart of tax avoidance. The deductions and credits available to you are not accidental loopholes. They are intentional incentives placed into the law by policymakers. When you engage in legal tax avoidance, you are often doing exactly what the government wants you to do. Let's look at a few clear examples to make this concept concrete. First, let's consider economic policy. The government wants to foster a strong, growing economy with plenty of jobs. To do this, it needs businesses to invest, innovate, and expand. So, how does the tax code encourage this? It might offer a deduction for depreciation, allowing a company to write off the cost of new machinery over time. This makes it more affordable for a factory to upgrade its equipment, making it more competitive and potentially leading to more hiring. It might offer a tax credit for research and development, incentivizing a software company to invest in creating the next big technological breakthrough. These tax provisions are not mistakes. They are strategic levers to spur economic activity. Second, let's think about social policy. Policymakers have long believed that homeownership helps create stable communities. To encourage more people to buy homes, Congress created the mortgage interest deduction. This allows homeowners to deduct the interest they pay on their home loan from their taxable income, effectively lowering the cost of owning a home. Similarly, the government wants to encourage charitable giving. So, it created a deduction for donations to qualified nonprofit organizations. This provides a financial incentive for individuals to support charities, churches, and universities, which in turn provide vital services to the community. Finally, let's look at individual behavior. The government knows that a population with a secure retirement and a good education is beneficial for the country's long-term health. But how can it encourage people to save for retirement or pursue higher education? Through the tax code. It created tax-advantaged retirement accounts like the 401k and the IRA. By allowing you to contribute pre-tax money or get a deduction for your contribution, the government is actively helping you save for your future. To promote education, it created tax credits like the American Opportunity Tax Credit, which helps offset the high cost of college tuition. When you contribute to your 401k, deduct your mortgage interest, or claim an education credit, you are participating in the system exactly as it was designed. You are practicing tax avoidance, and in doing so, you are responding to a specific policy signal sent by the government. This approach is what has led to the tax code's immense complexity. Every time a new policy goal emerges, new layers of tax law are often added. While this complexity can be frustrating, it is a direct result of the code being used as a flexible tool for governance. This brings us back to our central theme. Tax avoidance is the act of navigating this complex system of incentives. It is the legal and ethical process of aligning your financial decisions with the behaviors the government has chosen to reward. Tax evasion, on the other hand, operates completely outside of this policy framework. Hiding cash income, for example, does not advance any social or economic goal. It is a simple act of theft from the public treasury, undermining the entire system that pays for the services we all rely on. It starves the system of the revenue it needs and shifts the tax burden unfairly onto honest taxpayers who play by the rules. In summary, the U.S. tax code is not just a mechanism for revenue collection. It is a dynamic instrument of national policy. The opportunities for legal tax avoidance exist by design, created to encourage economic growth, achieve social objectives, and influence individual behavior. Understanding this purpose is the key to seeing why avoidance is a legitimate and accepted part of the system, while evasion is a crime that attacks its very foundation. In our next chapter, we will begin to move from the why to the how. We will start breaking down the most common categories of deductions and adjustments available to individual taxpayers, starting with those you can take even if you don't itemize. Welcome back to our series, Tax Evasion versus Tax Avoidance. In the previous chapter, we established that the U.S. tax code is a complex policy tool designed to encourage certain behaviors. Legal tax avoidance is the process of aligning your financial activities with these incentives. Today, we begin to explore the how, by looking at one of the first and most powerful ways to legally reduce your taxable income: above-the-line deductions. As always, we must begin with our important reminder. This information is for educational purposes only. It is not legal or tax advice. The tax code is incredibly detailed and rules change. Please consult with a qualified tax professional or attorney for advice that is specific to your personal financial situation. When you start to prepare your tax return, one of the first key figures you will calculate is your adjusted gross income, or AGI. Think of AGI as a crucial checkpoint. It's your gross income, all the money you earn from all sources, minus a specific list of deductions. These deductions are often called adjustments to income, or more popularly, above-the-line deductions. The line they are above is the line on your tax form that shows your AGI. Lowering your AGI is important not just because it directly reduces the amount of income you'll be taxed on, but also because your AGI is used to determine your eligibility for many other tax credits and deductions further down the line. So, what are these above-the-line deductions? They are the government's way of rewarding you for certain types of spending and saving. A key feature is that you can take these deductions whether you itemize or take the standard deduction, a topic we'll cover in detail in the next chapter. Let's walk through a few of the most common examples. One of the most well-known is the traditional IRA deduction. An IRA, or individual retirement arrangement, is a personal savings plan. When you contribute money to a traditional IRA, the government often allows you to deduct that contribution from your income for the year. Why? As we discussed in Chapter 2, this is a policy tool. The government wants to encourage you to save for your own retirement, which reduces the potential future strain on social safety nets. By giving you a tax break now, they are incentivizing responsible long-term planning. It's important to note that the full deductibility can depend on your income level and whether you're also covered by a retirement plan at work, which highlights the importance of understanding the specific rules. Another very common above-the-line deduction is for student loan interest. If you are paying back student loans for your own, your spouse's, or your dependent's education, You can typically deduct the interest you paid, up to a limit set by law. The policy goal here is clear: to lessen the financial burden of higher education. By making student loans slightly more affordable through this tax break, the government hopes to foster a more educated and skilled workforce. The amount you paid in interest is reported to you and the IRS by your lender on a form called 1098-E. A third example is the deduction for contributions to a health savings account, or HSA. An HSA is a tax-advantaged savings account that can be used for healthcare expenses, and it's available to those with a high-deductible health insurance plan. Contributions you make to your HSA are deductible. The government's goal is twofold: to encourage individuals to save proactively for their medical costs, and to promote the use of high-deductible health plans, which some policymakers believe help to control overall healthcare spending. Let's consider one more: the educator expense deduction. This allows eligible teachers and other educators to deduct a modest amount of money they spent on unreimbursed classroom supplies. While the dollar amount is small, the policy is significant. It's a recognition by the government that many teachers reach into their own pockets to buy books, art supplies, and other materials for their students. This deduction provides a small measure of financial relief and acknowledges their personal investment in education. In each of these examples, retirement savings, student loan payments, health savings, and educator expenses, the deduction is a reward for a behavior the government wants to promote. Taking these deductions is a perfect illustration of legal tax avoidance. However, this brings us to a critical point that keeps you on the right side of the law: documentation. To claim any deduction, you must have proof. For your IRA contribution, you'll have statements from your financial institution. For your student loan interest, you have your 1098-E form. For educator expenses, you should keep your receipts. This is where avoidance and evasion diverge sharply. The person practicing tax avoidance says, "I spent this amount on a legally deductible expense, and here is the receipt to prove it." The person practicing tax evasion might say, "I'll just invent an expense and hope I don't get caught." One is based on truth and records, the other is based on fiction and fraud. To summarize today's chapter, above-the-line deductions are a set of valuable, targeted tax breaks that reduce your adjusted gross income. They are a core component of how the government uses the tax code to influence behavior, and taking the ones you legally qualify for is a smart and legitimate form of tax avoidance. In our next chapter, we will cross below the AGI line and explore one of the biggest decisions every taxpayer has to make: whether to take the standard deduction or to itemize. This choice opens up a whole new set of rules and opportunities for legal tax planning. Welcome back to Tax Evasion versus Tax Avoidance. In our last chapter, we looked at above-the-line deductions and how they help determine your adjusted gross income, or AGI. Once you have that critical AGI number, you arrive at a major fork in the road, a fundamental choice that nearly every taxpayer must make. That choice is whether to take the standard deduction or to itemize your deductions. How you choose will significantly impact the amount of tax you legally owe. Before we dive in, let's restate our essential disclaimer. The information in this series is provided for educational purposes only and should not be taken as legal, financial, or tax advice. The U.S. tax code is complex and subject to frequent changes. Always seek the counsel of a qualified professional for advice tailored to your unique situation. So what is this choice all about? After you've calculated your AGI, the tax code allows you to reduce it even further before calculating your actual tax. The government has created two distinct paths to accomplish this. The first path, and the one taken by the vast majority of Americans, is the standard deduction. Think of the standard deduction as a no-questions-asked, fixed dollar amount that you can subtract from your AGI. Its primary purpose is to simplify the tax filing process. The amount you can take depends on several factors: your filing status, such as single, married, filing jointly, or head of household; your age, there's a higher amount for those 65 or older; and whether you or your spouse are blind. The standard deduction represents a baseline amount of income that the government has decided should not be taxed. Taking it is the most straightforward form of legal tax avoidance. You don't need to save a shoebox full of receipts or track every single expense. You simply take the amount that the law says you are entitled to based on your circumstances. This path offers simplicity and ease. The second path is to itemize deductions. Instead of taking the one-size-fits-all standard deduction, you can choose to add up a list of specific, eligible expenses. If the total amount of these itemized expenses is greater than the standard deduction you would otherwise receive, it makes financial sense to itemize. This path requires more work and, most importantly, diligent record keeping, but it can result in a lower tax bill for those with significant deductible expenses. So, what kinds of expenses can be itemized? While the list can be long and the rules specific, they generally fall into a few major categories, each with a clear policy reason behind it. One of the most significant is the deduction for state and local taxes, often referred to as SALT. This allows you to deduct the amount you paid in either state and local income taxes or state and local sales taxes, plus the amount you paid in property taxes. There is a legal cap on the total amount you can deduct here. The policy goal is to reduce the effect of being taxed on the same income by multiple levels of government. Another major itemized deduction is for home mortgage interest. As we've mentioned before, the government wants to encourage homeownership, viewing it as a social good. This deduction, which allows you to deduct the interest paid on your home loan, is a powerful incentive designed to make owning a home more affordable. Charitable contributions are also a classic itemized deduction. When you donate money or goods to a qualified nonprofit organization, such as a church, a food bank, or a university, you can deduct the value of that contribution. The government's purpose here is to incentivize private citizens to financially support organizations that serve the public good, lessening the burden on government-funded programs. Finally, there's the deduction for medical and dental expenses. This one has a high bar. You can only deduct unreimbursed medical expenses that exceed a significant percentage of your adjusted gross income. The policy is not to cover routine checkups, but to provide a measure of financial relief for individuals and families who are hit with catastrophic or very high healthcare costs in a given year. Choosing to itemize is a strategic financial decision. It is tax avoidance in its purest form. It involves understanding the law, keeping meticulous records of your expenses throughout the year, receipts for charitable donations, property tax bills, records of medical payments, and then doing the math to see which path, standard or itemized, benefits you more. Here again, the bright line between avoidance and evasion is crystal clear. The tax avoider keeps a receipt for the $500 they donated to a legitimate charity. The tax evader creates a fake receipt for $5,000 to a charity they never gave to. The tax avoider keeps accurate records of their mortgage interest paid. The tax evader falsely claims they paid twice as much as they actually did. The difference is truth versus fiction, documentation versus fraud. In summary, after determining your AGI, you must choose between the simplicity of the standard deduction and the potential extra savings from itemizing your specific deductible expenses. This choice is a central part of tax planning and a key example of how taxpayers can legally work within the system to minimize their tax liability. In our next chapter, we're going to explore a different, and often more powerful, tool for lowering your tax bill: tax credits. We'll explain the crucial difference between a deduction and a credit, and why that difference matters so much. Welcome back to Tax Evasion versus Tax Avoidance, the critical legal line in the US. In our last two chapters, we explored the world of deductions, from above-the-line adjustments to the big choice between the standard deduction and itemizing. All of these deductions serve one primary purpose: to lower your taxable income. Today we're going to discuss a different, and often much more powerful, tool in the tax code: the tax credit. As we proceed, please remember our essential disclaimer. This series is for educational and informational purposes only, and is not a substitute for professional legal, financial, or tax advice. Always consult with a qualified professional who can analyze your specific circumstances. So, what is the difference between a deduction and a credit? This is one of the most important distinctions in the entire tax code, and understanding it is key to understanding legal tax avoidance. Let's put it simply: a tax deduction reduces the amount of your income that is subject to tax. A tax credit reduces your actual tax bill dollar for dollar. Here's an analogy to make that clear. Imagine your total income is a large pie. A deduction is like legally being allowed to remove a slice of that pie before the government calculates its share. If you remove a $1,000 slice with a deduction, the government's tax calculation will be based on a smaller pie. A tax credit, on the other hand, happens after the government has already calculated its share, your total tax bill. A credit is like a gift card that you can use to pay that bill. A $1,000 tax credit means you owe the government exactly $1,000 less. Because of this, a dollar in tax credits is always more valuable than a dollar in deductions. For example, a $1,000 deduction for someone in the 22% tax bracket will save them $220, but a $1,000 tax credit will save them the full $1,000. It directly subtracts from the final amount you owe. To add another layer of understanding, tax credits themselves come in two main flavors: non-refundable and refundable. A non-refundable tax credit can reduce your tax liability all the way down to zero, but no further. If you owe $800 in taxes and you qualify for a $1,000 non-refundable credit, the credit will wipe out your $800 bill, but you don't get the remaining $200 back. It simply stops at zero. A refundable tax credit is even more powerful. It can also reduce your tax bill to zero, but if the credit is worth more than the tax you owe, the government will send you the difference as a refund. If you owe $800 in taxes and qualify for a $1,000 refundable credit, your tax bill becomes zero, and the IRS will send you a check for the remaining $200. Refundable credits are often used as policy tools to deliver financial support to specific groups, such as low to moderate income working families. Just like deductions, every tax credit exists in the code to encourage a specific behavior or to achieve a social policy goal. For example, the child tax credit is designed to help families with the significant cost of raising children. The American Opportunity Tax Credit is designed to make higher education more accessible by helping to offset the costs of tuition and fees for the first 4 years of college. And the Clean Vehicle Credit is a policy tool aimed at fighting climate change by incentivizing taxpayers to purchase electric cars. Claiming these credits is a cornerstone of legal tax avoidance. It requires that you meet every single one of the specific, and sometimes complex, qualifications laid out by the law. Do you have a qualifying child? Are you an eligible student at a qualified institution? Did you buy a vehicle that meets the government's strict criteria? Answering these questions honestly and accurately is what it means to play by the rules. And this, once again, is where we see the bright lines separating avoidance from evasion. The tax avoider carefully reads the rules for the child tax credit to confirm their child meets the age, relationship, and residency tests. The tax evader knowingly claims the credit for a niece or nephew who doesn't live with them, hoping they won't be audited. The tax avoider keeps records of tuition payments to prove their eligibility for an education credit. The tax evader invents phantom college expenses to claim a credit they don't deserve. The IRS pays very close attention to tax credit claims, precisely because they are so valuable. Improperly claiming a credit, whether through a misunderstanding or deliberate fraud, can lead to audits, back taxes, steep penalties, and in cases of willful evasion, even criminal charges. To summarize, tax credits are a direct, dollar-for-dollar reduction of your tax bill, making them more powerful than deductions. They are created by Congress to promote specific policy goals, and they come in two types: non-refundable, which can take your bill to zero, and refundable, which can result in a cash payment back to you. Legally claiming the credits you are entitled to is a smart and responsible part of managing your taxes. In our next chapter, we will take a step back and look at the very first decision on a tax return: your filing status. This choice, whether you file as single, married, filing jointly, head of household, and so on, is the foundation upon which all of these other calculations are built. Welcome back to Tax Evasion versus Tax Avoidance. In our journey so far, we've explored the tools the tax code provides for legally reducing your tax bill, such as deductions and credits. But before any of those tools can be used, you must make a foundational decision. It's the very first box you'll check on your tax return, and it defines who you are in the eyes of the IRS for that tax year. This is your filing status. As we begin, it is critical to remember our guiding principle. This content is for educational and informational purposes only. It is not designed to be, and should not be considered, legal or tax advice. Your filing status is determined by your specific life circumstances, and you should always consult a qualified professional to ensure you are choosing correctly. So, what exactly is a filing status? It is a category that defines your marital and family situation as of the very last day of the tax year, December 31st. This status is not a strategic preference. It is a legal classification based on the facts of your life. Your chosen filing status determines your standard deduction amount, the tax brackets your income will fall into, and your eligibility for a wide range of deductions and credits. Getting it right is the bedrock of a correct and legal tax return. There are 5 main filing statuses in the U.S. tax system. First, the most straightforward is single. This is for individuals who are unmarried, divorced, or legally separated and do not qualify for any other filing status. Second is married, filing jointly. This is for married couples who choose to combine their incomes, deductions, and credits onto a single tax return.
Disclaimer: this video is for informational and educational purposes only and should not be considered professional legal, financial, or tax advice. I am not a certified public accountant, CPA, or a tax attorney. You should consult with a qualified professional for advice tailored to your individual situation. Tax laws are complex and subject to change. The creator of this video or the channel will not be held liable for any actions taken based on the information provided.
The vast majority of married couples choose this status because the tax code often provides benefits, like higher income thresholds for credits and larger standard deductions, that treat the couple as a single economic unit. Third is married filing separately. This is an option for married couples to file two individual returns. This is far less common, and it often results in a higher overall tax bill because it disqualifies you from many of the tax benefits available to joint filers. While there can be very specific reasons a couple might choose this, such as a desire to keep their tax liabilities completely separate, it's a more complex path. Fourth, we have head of household. This status provides a tax benefit to those who are unmarried and are shouldering the primary financial burden of a home. To qualify, you must be unmarried, pay for more than half of the household's upkeep, and have a qualifying child or dependent relative living with you for more than half the year. The policy goal is clear: to provide some tax relief to single individuals, often single parents, who have the significant expense of supporting a family on their own. Finally, there is the qualifying surviving spouse, sometimes called qualifying widow or widower. This is a less common status that allows a surviving spouse with a dependent child to use the more favorable married filing jointly tax rates for up to 2 years after the year of their spouse's death. This is a compassionate provision in the tax code, designed to ease the financial transition for a grieving family. Now let's bring this back to our central theme. How does filing status relate to the line between tax avoidance and tax evasion? Tax avoidance is carefully understanding the detailed legal requirements for each status, and then selecting the most beneficial one that you legally qualify for. For instance, a recently divorced parent who has their child living with them would read the IRS rules for head of household. They would add up their household expenses to confirm they paid more than 50%, and they would confirm their child meets the definition of a qualifying child. This is responsible tax planning. Tax evasion in this context is deliberate misrepresentation. It is claiming a filing status you know you are not entitled to, simply to get a better result. For example, a single person with no dependents who claims to be head of household is committing fraud. A couple who divorced in May but still files a joint return in the following year, because the tax outcome is better, is breaking the law. Your filing status is based on your real-world situation, not wishful thinking. Lying about your marital status or who lives in your home to the IRS is a clear act of tax evasion, and can lead to audits, penalties, and severe legal consequences. To summarize, your filing status is the mandatory starting point of your tax return. It is a legal classification based on your life on the last day of the year, and it dictates how the rest of the tax rules will apply to you. Choosing the correct status is a matter of law, not preference, and it is a perfect example of where honesty and accuracy draw the bright line between legal compliance and illegal evasion. In our next chapter, we will build on this foundation and discuss how your filing status and income level come together to determine your tax bracket, and how the progressive U.S. tax system actually works. Welcome back to Tax Evasion versus Tax Avoidance. We've traveled a significant path so far. We started with your total income, subtracted above-the-line deductions to find your adjusted gross income, and then subtracted either the standard or itemized deductions. This process of legal reduction leads us to a final, crucial number: your taxable income. Today we'll explore what that number means and how the U.S. tax bracket system applies to it. As we delve into these mechanics, we must reiterate our foundational disclaimer. This content is for educational and informational purposes only and does not constitute legal, financial, or tax advice. The tax system is complex, and you should always consult a qualified professional for personalized guidance. Your taxable income is the bottom line amount of your earnings that is actually subject to federal income tax. The entire goal of the strategies we've discussed so far, claiming deductions for example, is to make this taxable income number as low as the law allows. Once this number is determined, the next step is to calculate the tax itself. To do that, we need to understand the structure of the U.S. tax system. The United States uses a progressive tax system. This simply means that higher portions of income are taxed at higher rates. The core idea behind this policy is that those with a greater ability to pay should contribute a higher percentage of their income to fund public services. This is different from a flat tax, where every single person, regardless of income, would pay the same rate. The progressive system is organized into what are called tax brackets. This is one of the most misunderstood concepts in personal finance. A common myth is that if you earn more money and move into a higher bracket, all of your income is suddenly taxed at that new, higher rate. This is completely false, and worrying about it can cause unnecessary anxiety. The truth is much more logical. Think of your taxable income as water filling a series of buckets, one after the other. Each bucket is a tax bracket, and each has its own tax rate. Let's use a simple, hypothetical example to see how it works. Imagine the tax brackets for a single filer are 10% on the first $10,000 of income, 20% on income between $10,001 and $40,000, and 30% on income over $40,000. Now let's say your taxable income for the year is $50,000. You don't just pay 30% on the whole amount. Instead, it works like this. The first $10,000 fills the first bucket and is taxed at 10%, which equals $1,000 in tax. Then, the next $30,000 of your income, from $10,001 up to $40,000, fills the second bucket. That portion is taxed at 20%, which equals $6,000 in tax. Finally, only the remaining $10,000 of your income, from $40,001 up to your total of $50,000, spills into the third bucket. Only that last amount is taxed at the 30% rate, which equals $3,000 in tax. Your total tax bill would be the sum from all the buckets. $1,000 plus $6,000 plus $3,000, for a total of $10,000. The most important takeaway is this. Earning more money will never result in you taking home less money. Only the dollars that fall into a new, higher bracket are taxed at that higher rate. This system gives rise to two important terms: your marginal tax rate and your effective tax rate. Your marginal rate is the rate you pay on your very last dollar of income. In our example, that was 30%. Your effective tax rate, however, is your total tax divided by your total taxable income. In our example, that's $10,000 divided by $50,000, which is 20%. Your effective, or average, tax rate is almost always lower than your top marginal rate. Understanding this system is central to legal tax avoidance. Knowing your marginal tax bracket helps you understand the precise value of a tax deduction. For someone in our 30% marginal bracket, a $1,000 deduction saves them $300 in taxes. Tax evasion, by contrast, seeks to cheat this system entirely. An evader isn't thinking about how their income fits into the brackets. They are focused on hiding income, so it never gets reported at all. Failing to report $20,000 in cash is an attempt to make that money invisible to the entire system, preventing it from ever filling even the first and lowest tax bucket. In summary, your taxable income is the amount the government ultimately taxes. This tax is calculated using a progressive bracket system, where different portions of your income are taxed at incrementally higher rates. This ensures that a higher income leads to a higher tax bill, but it does so in a gradual, tiered way. In our next chapter, we will turn our attention to one of the most practical and crucial aspects of staying on the right side of the law: the absolute necessity of good record keeping. Welcome back to Tax Evasion versus Tax Avoidance. We have spent the last several chapters navigating the rules of the tax system: deductions, credits, filing statuses, and tax brackets. But all of these rules rest on a single, practical foundation: the records you keep. Today, we're talking about the paper trail. It's not the most exciting topic, but it is arguably the most important in keeping you on the right side of the bright line between avoidance and evasion. As always, we must start with our disclaimer. This information is for educational purposes only. It is not legal or tax advice. The specific records you need to keep can depend on your unique circumstances, and you should always consult with a qualified professional. In the United States tax system, the burden of proof rests squarely on the shoulders of the taxpayer. This is a critical concept to understand. It means the IRS does not have to prove that a deduction you claimed is incorrect. You have to be able to prove that it is correct. Your tax return is essentially a series of claims you are making to the government. Your records are the evidence that backs up every single one of those claims. Without evidence, they are just numbers on a form. So, what kind of records should you be keeping? Broadly speaking, you need documentation for everything that supports the figures on your return. Let's start with income. This seems simple, but it's vital. You need to keep your W-2 forms from employers, any 1099 forms you receive for freelance or contract work, and bank statements that show deposits. If you have investments, you'll need the statements that report interest, dividends, and capital gains. This documentation proves the source and amount of all the money you earned. Next are the records for expenses, deductions, and credits. This is where diligence is key, especially if you itemize or own a business. This includes things like receipts for medical expenses, charitable contributions, and business-related purchases. Canceled checks or credit card statements that corroborate those receipts. For charitable donations, especially larger ones, you need a written acknowledgement from the charity itself. If you're claiming a deduction for business use of your car, you need a detailed mileage log showing the date, distance, and purpose of each trip. Think of it this way. If you claim a deduction, you should have a piece of paper or a digital file that can prove the expense is real, that you paid it, and that it qualifies under the tax law. How long do you need to hold on to this mountain of paper? The IRS has a guideline called the period of limitations, which is the time frame they have to audit your return or assess additional taxes. The general rule is to keep records for 3 years from the date you filed your tax return. However, there are important exceptions. The period extends to 6 years if you have substantially underreported your gross income, typically by more than 25%. And most importantly, if you file a fraudulent return or fail to file a return at all, the period of limitations never ends. The IRS can come back and question those returns at any time. This fact alone highlights the severe and long-lasting consequences of tax evasion. This brings us directly to the core theme of our series. Record keeping is the tangible, physical manifestation of the difference between tax avoidance and tax evasion. The person practicing tax avoidance builds their tax return on a foundation of honest, organized records. They claim a $200 deduction for a donation to a local food bank because they have the canceled check and the acknowledgement letter from the organization. Their tax return is a true story told by their documents. The person practicing tax evasion, by contrast, operates in a world of missing or fabricated records. They might invent a $200 a month business expense for supplies they never bought. They might take a legitimate receipt for a $50 donation and try to alter it to say $500. They might deliberately destroy the records of cash payments they received for work. Their tax return is a work of fiction. Good records are your proof of your good faith. They are your shield and your defense. In the event your return is ever questioned, your records are what will demonstrate that you acted honestly and followed the rules. They prove that you are a tax avoider, not a tax evader. In summary, maintaining clear, complete, and organized records is a fundamental responsibility for every American taxpayer. It is the essential daily practice that gives you the evidence to legally minimize your taxes and confidently stand behind the numbers on your return. In our next chapter, we will address a topic that is a source of great anxiety for many: the IRS audit. We'll demystify the process, discuss what might trigger an audit, and explain what happens when the IRS decides to take a closer look at your return. Welcome back to Tax Evasion versus Tax Avoidance. In our last chapter, we established that good record keeping is your first line of defense. Today, we're going to talk about the situation where you might actually need that defense: the IRS audit. For many people, the word audit itself can cause a great deal of anxiety. The goal of this chapter is to pull back the curtain on this process, to understand what an audit is, why one might happen, and how it clearly illustrates the ultimate consequences of the choice between avoidance and evasion. Before we proceed, it is absolutely essential to state our disclaimer. This information is for educational purposes only and is not legal or tax advice. If you receive a notice from the IRS, you should seek immediate assistance from a qualified tax professional, such as a CPA or a tax attorney, who can represent you and protect your rights. First, let's define our terms. What is an IRS audit? An audit is simply a review of your tax return by the IRS to verify that your income, deductions, and credits are reported accurately and in compliance with tax law. It is crucial to understand that an audit is not automatically an accusation of wrongdoing. Many audits are simple requests for clarification and are closed with no changes to the tax return at all. So, how does the IRS decide which returns to audit? The image of an agent randomly picking a name out of a hat is a myth. The process is far more systematic. The primary method is a sophisticated computer program, known as the Discriminate Information Function, or DIF system. This program scores every tax return based on a secret formula. It compares your return to a set of norms for taxpayers in similar financial situations. If your return has a high DIF score, it means it has a higher statistical probability of containing an error that needs to be addressed. This doesn't mean you did anything wrong. It just means your return stands out from the statistical average. Another common reason for contact is a simple computer mismatch. The IRS receives copies of all W-2s and 1099s issued. Their computers automatically cross-reference these with the income you report. If you received a 1099 for freelance work and forgot to include it on your return, the system will flag it and automatically send you a notice. This is the most common form of IRS inquiry. Finally, a very small number of returns are selected for audit completely at random. This helps the IRS gather data and ensure fairness across all segments of the tax-paying population. Just as there are different reasons for an audit, there are different types of audits. The vast majority are correspondence audits. This is the least intimidating type and is handled entirely through the mail. The IRS will send you a letter asking for documentation to support a specific item on your return. For example, proof of a large charitable donation or records for educational expenses. The next level is an office audit. Here, you will be asked to visit a local IRS office and meet with an auditor to review your records in person. This is more involved and typically focuses on a handful of specific, predetermined issues. The most serious and least common type for individuals is a field audit. This is where an IRS agent conducts the audit at your home or place of business. These are generally reserved for the most complex returns, such as those for large businesses. Now let's connect this directly to our central theme. An audit is the moment where the path you've chosen, avoidance or evasion, truly matters. For the person who has diligently practiced tax avoidance, an audit is certainly a stressful and inconvenient event, but it is a manageable one, because they have kept the honest, organized records we discussed in the last chapter. They can answer the IRS's request. If asked to prove a business expense, they can provide the receipt and the mileage log. If asked to verify a charitable donation, they can provide the acknowledgement letter. Their good records are the proof of their good faith. The audit may result in no change, or perhaps a small adjustment based on a different interpretation of a rule, but it will not uncover fraud. For the person who has chosen tax evasion, an audit is a catastrophe. They have no legitimate records to support their false claims. When the auditor asks for proof of the non-existent business they claimed losses from, they have nothing to show. When asked for receipts for the thousands of dollars in fake medical expenses they deducted, they cannot produce them. The audit doesn't just correct an error, it uncovers a lie. This is where the process moves beyond a simple review and into the realm of penalties and, in serious cases, criminal investigation. In summary, an IRS audit is a verification process, not a presumption of guilt. Returns are most often selected by impartial computer systems looking for statistical outliers. While no one wants to be audited, the process itself powerfully reveals the wisdom of practicing legal tax avoidance built on a foundation of honest and thorough records. In our next chapter, we will explore the specific consequences when an audit goes wrong. We'll discuss the range of civil penalties, from interest charges to steep fines, that the IRS can impose for everything from simple mistakes to deliberate fraud. Welcome back to Tax Evasion versus Tax Avoidance. In our last chapter, we demystified the IRS audit, the process by which tax returns are examined for accuracy. Now we must confront the logical next question. What happens when that examination finds that you owe more tax? The consequences are not just about paying the tax you originally missed. There are additional costs in the form of interest and a wide range of civil penalties. Before we explore these financial consequences, please remember our essential disclaimer. This is for educational purposes only and is not legal or tax advice. The application of penalties and interest is highly dependent on individual facts and circumstances. If you are facing a tax debt, it is crucial to consult with a qualified tax professional. When an audit or an IRS notice concludes that you've underpaid your taxes, the total amount you owe is typically composed of three distinct parts. First is the additional tax itself. This is the base amount, the money that should have been paid by the tax deadline. This is simply the government collecting the revenue it was legally due. Second, the IRS charges interest on the underpaid amount. The logic is straightforward. When you didn't pay your taxes on time, you were, in effect, holding onto the government's money. The interest charge is like the fee for this unauthorized loan. It begins accruing on the tax due date and compounds daily until the balance is paid in full. This can significantly increase the total amount owed over time. The third and most critical component is penalties. Penalties are additions to the tax that are specifically designed to punish noncompliance and encourage taxpayers to follow the rules in the future. The IRS has a spectrum of civil penalties that are applied based on the nature and severity of the taxpayer's actions. On one end of the spectrum, we have penalties for common compliance failures. The failure to file penalty applies if you don't file your return by the due date, and the failure to pay penalty applies if you don't pay the tax you owe on time. The government considers filing your return on time to be so important that the penalty for failing to file is typically much higher than the penalty for failing to pay. Moving up in severity, we encounter the accuracy-related penalty. This is a very common penalty, and it is typically 20% of the portion of your underpayment that is due to specific types of errors. This penalty can be applied for things like negligence, which means you didn't make a reasonable attempt to follow the tax laws, or for a substantial understatement of your tax liability. This penalty targets carelessness and significant mistakes. At the far end of the spectrum is the most severe civil penalty of all, the civil fraud penalty. This penalty is a staggering 75% of the underpayment that is attributable to fraud. This is not for honest mistakes. The IRS imposes this penalty when it can prove that the taxpayer engaged in intentional wrongdoing. It requires showing that the taxpayer knew what the law was and willfully and deliberately violated it to evade taxes. This spectrum of penalties brings the difference between tax avoidance and tax evasion into sharp financial focus. An individual practicing tax avoidance might make an honest mistake. They might misinterpret a very complex rule about a deduction. If an audit uncovers this, they will have to pay the additional tax, plus the accrued interest. They may even be assessed the 20% accuracy-related penalty for the error. It's a costly mistake, but it's treated as just that, a mistake. Now consider the individual who practices tax evasion. They get caught deliberately hiding $50,000 in cash income. They will owe the back tax on that $50,000, plus all the accrued interest. But because their action was not a mistake but a deliberate attempt to deceive, the IRS will seek to impose the 75% civil fraud penalty on top of everything else. The financial consequence of their intentional act is exponentially more severe. In summary, the cost of being wrong on your tax return goes far beyond simply paying the tax you missed. It includes daily compounding interest and a system of penalties designed to distinguish between honest errors and deliberate deception. While a simple mistake can be expensive, the 75% civil fraud penalty stands as the tax code's clear and powerful financial punishment for the act of tax evasion. This covers the civil side of the law. But what happens when the government decides that even a 75% penalty isn't enough? In our next chapter, we will cross the bright line into the most serious territory of all, criminal tax prosecution. We will discuss when and why tax evasion becomes a crime, and what that can mean for the person who gets caught. Welcome back to Tax Evasion versus Tax Avoidance. In our last chapter, we detailed the steep financial costs of civil tax fraud, interest and penalties that can far exceed the original tax owed. Today we cross the most serious line of all. We move from civil law, where the disputes are about money, to criminal law, where the stakes are a person's freedom. This chapter is about what happens when tax evasion becomes a federal crime. Given the extreme gravity of this topic, our disclaimer is more important than ever. The following is for educational purposes only and is not legal advice. The information provided is a general overview of a complex area of law. Anyone facing a potential criminal tax investigation must seek immediate representation from a qualified criminal tax attorney. While the IRS handles civil audits and penalties, the most serious cases are referred to its law enforcement branch, IRS Criminal Investigation, and can ultimately be prosecuted by the Department of Justice. The primary criminal statute is found in Title 26 of the U.S. Code, Section 7201, and it is very clear. Any person who willfully attempts in any manner to evade or defeat any tax is guilty of a felony. For the government to convict someone of criminal tax evasion, it must prove three specific elements beyond a reasonable doubt, the highest standard of proof in the legal system. First, there must have been an affirmative act. This means the person took a specific, intentional action to mislead the government or conceal the truth. This is more than just failing to file a return. It's an act of commission, not just omission. Examples of affirmative acts include keeping a double set of books, making false entries or invoices, destroying records, or concealing assets in offshore accounts or under other names. Second, there must be a tax deficiency. The government must prove that because of the affirmative act, there was an actual underpayment of tax. In simple terms, the government has to show it was actually cheated out of money it was legally owed. Third, and most importantly, is the element of willfulness. This is the key that separates a civil error from a criminal act. The government must prove that the taxpayer acted voluntarily and intentionally to violate a known legal duty. An accident, a misunderstanding of a complex law, or simple carelessness is not a crime. Willfulness implies a deliberate, conscious choice to break the law. The government has to prove that the person knew what they were doing was wrong, and did it anyway. This high standard of proof is what separates civil fraud from criminal fraud. In a civil case, The IRS can impose the 75% fraud penalty if it can show fraud by clear and convincing evidence. But to put someone in prison, the government must prove its case to a jury beyond a reasonable doubt. So who actually gets prosecuted? The IRS doesn't have the resources to prosecute every case of evasion. Instead, its Criminal Investigation Division focuses on cases that will have the greatest deterrent effect on the public. The main goal of criminal prosecution is to send a clear message to all other taxpayers that the consequences of cheating are severe, thereby encouraging everyone else to voluntarily comply with the law. Cases selected for criminal investigation often involve a pattern of evasion over several years, large amounts of unpaid taxes, or connection to other illegal activities like money laundering. They also frequently target individuals in positions of public trust or with a high profile, because these prosecutions generate publicity and serve as a powerful warning to others. This is the ultimate end of the road for the two paths we've been discussing throughout this series. The path of tax avoidance exists entirely within the world of civil law. You can have a dispute with the IRS about the interpretation of a deduction. That dispute might even end up in U.S. tax court. But because there is no willfulness, no intent to deceive, it is not a criminal matter. The path of tax evasion, however, when marked by a pattern of willful and affirmative acts of deceit, leads directly to the criminal justice system. Here, the taxpayer is no longer a taxpayer, but a defendant. The discussion is no longer about interest rates and penalty percentages, but about felony convictions, federal sentencing guidelines, and the potential for incarceration. In summary, tax evasion is not just a violation of the tax code, it is a federal crime. A criminal conviction requires the government to prove, beyond a reasonable doubt, a willful and affirmative act to cheat the government out of taxes owed. These prosecutions are pursued strategically to punish the most serious offenders and, more importantly, to uphold the integrity of the entire tax system by deterring others from crossing that bright, critical line. In our next chapter, we'll step back from the brink and discuss a vital topic for honest taxpayers: what to do if you realize you've made a mistake on a past tax return. We'll explore the proper way to correct it by filing an amended return. Welcome back to Tax Evasion versus Tax Avoidance. Our last chapter was a heavy one, exploring the severe consequences of criminal tax evasion. Today we step back from that extreme and return to the perspective of the vast majority of taxpayers. Honest people who want to follow the rules but know that sometimes mistakes happen. This chapter is about the clear and proper path the law provides for correcting those mistakes: the amended tax return. As we discuss this process, please remember our standard disclaimer. This is for educational purposes only and does not constitute procedural or legal advice. If you believe you need to amend a tax return, it is highly recommended that you consult with a qualified tax professional who can guide you through the specifics of your situation. So, what happens if you've already filed your tax return, but then you realize you made an error? Perhaps you received a corrected income statement from your employer, or you found a receipt for a large charitable donation you forgot to include. The solution is not to panic. It's to file an amended tax return. The specific form for this is Form 1040-X, Amended U.S. Individual Income Tax Return. This form allows you to correct a previously filed return to report changes to your income, deductions, credits, or filing status. It's a foundational part of the tax system, built on the understanding that people are human and errors can occur. There are many common reasons why a taxpayer might need to file an amended return. For example, you might receive a corrected W-2 form from your employer or a 1099 form from a client after you've already filed your taxes for the year. You might discover you were eligible for a tax deduction or credit that you failed to claim, and you are now owed a larger refund. Conversely, you might realize that you forgot to report a source of income, perhaps from a small side business or an investment. Or you may discover that you used the wrong filing status in a prior year. The process for amending a return has a time limit. Generally, you must file Form 1040-X within 3 years from the date you filed your original return, or within 2 years from the date you paid the tax, whichever is later. Depending on the correction, filing an amended return will result in one of two outcomes.
Disclaimer: this video is for informational and educational purposes only, and should not be considered professional legal, financial, or tax advice. I am not a certified public accountant, CPA, or a tax attorney. You should consult with a qualified professional for advice tailored to your individual situation. Tax laws are complex and subject to change. The creator of this video or the channel will not be held liable for any actions taken based on the information provided.
You will either receive an additional refund from the IRS, or you will owe additional tax. If you do owe more, it is best to pay it as soon as possible to minimize the interest and any potential penalties that may have accrued. This brings us to the core theme of our series, because the act of voluntarily amending a tax return is one of the clearest illustrations of the mindset of an honest taxpayer. It is the absolute opposite of tax evasion. Think about the legal elements we discussed in the last chapter. The key to a criminal case is willfulness, the intentional violation of a known legal duty. When a taxpayer discovers an error on their own and takes the initiative to file a Form 1040-X to correct it, their action is a powerful statement. It demonstrates a clear intent to comply with the law. It says, "I made a mistake and I want to make it right." This act of voluntary compliance is viewed very favorably by the IRS and stands in stark contrast to the behavior of someone who is willfully trying to deceive the system. The tax evader knows they have unreported income or have claimed a fake deduction. Their entire goal is concealment, and they hope they are never discovered. The honest taxpayer, upon discovering an error, seeks to correct it. Their goal is compliance. This principle is so important that there are formal and informal voluntary disclosure practices. While these are complex and apply to very serious situations, the underlying idea is simple. It is always better for a taxpayer to proactively and honestly correct a significant error than it is to wait for the IRS to find it during an audit. The act of coming forward demonstrates good faith and can significantly reduce penalties and, in many cases, eliminate the risk of criminal prosecution. In summary, the amended return process is a vital safety valve in our tax system. It allows conscientious taxpayers to ensure their tax filings are accurate, even after the fact. Choosing to file an amended return to correct an error is a hallmark of a responsible taxpayer and a definitive action that separates a person who makes an honest mistake from one who intends to commit fraud. In our next chapter, we'll discuss the people who can help you navigate these complexities. Tax professionals. We'll explore the different types of preparers, their roles, and your responsibilities when you hire someone to help with your taxes. Welcome back to Tax Evasion versus Tax Avoidance. Throughout this series, we've explored the immense complexity of the U.S. tax code. For the average person, navigating these rules can feel overwhelming. That's why many taxpayers choose to seek help from a professional. Today, we'll discuss the different types of tax professionals, their roles, and the most important thing to remember when you hire one: your ultimate responsibility. As we begin, please note our disclaimer. This chapter provides a general overview for educational purposes and is not a recommendation or endorsement of any specific type of professional. The choice of a tax preparer is a personal one, and you should perform your own due diligence. When seeking tax help, you will generally encounter a few main types of credentialed professionals. First, there are certified public accountants or CPAs. CPAs are licensed and regulated by their state's Board of Accountancy. They have broad training in accounting, finance, and business, in addition to taxation. A CPA can not only prepare your tax return, but can also provide wider financial planning advice and can represent you before the IRS in audits or other matters. Next are enrolled agents or EAs. Enrolled agents are licensed directly by the IRS. They are tax specialists. To become an EA, a person must either pass a comprehensive 3-part examination on all aspects of the tax code, or have extensive experience working for the IRS. EAs have unlimited rights to represent taxpayers before the IRS, meaning they can handle any tax matter on your behalf. Finally, there are tax attorneys. These are lawyers who specialize in the complex field of tax law. While they can prepare tax returns, their unique expertise is invaluable when dealing with complex legal disputes, appeals, U.S. tax court litigation, and especially any criminal tax matter. Communications with a tax attorney are also protected by attorney-client privilege, which is a level of confidentiality that other professionals cannot offer. Hiring a qualified and ethical professional is a key strategy in the practice of legal tax avoidance. They are experts who dedicate their careers to understanding the tax code. They can help you identify deductions and credits you may have missed and structure your finances in a tax-efficient way, all while ensuring you remain in full compliance with the law. However, this leads us to the single most important point of this chapter. You, the taxpayer, are ultimately and legally responsible for the accuracy of every single number on your tax return, even if you pay someone else to prepare it. When you sign your tax return, you are signing a legal declaration under penalty of perjury. You are stating that you have examined the return and, to the best of your knowledge, it is true, correct, and complete. This responsibility cannot be outsourced. Think of it this way. A reputable tax professional is your guide and your expert resource. They are not a shield you can hide behind if you provide them with false information. This is where the line between avoidance and evasion becomes incredibly sharp. When practicing tax avoidance, the relationship with your professional is a partnership built on honesty. You provide them with complete and accurate records of all your income and expenses. They, in turn, use their expertise to apply the tax law to your situation to legally minimize your tax liability. When a person decides to commit tax evasion, they might try to use a professional to legitimize their fraud. For example, they might hire a CPA but deliberately fail to tell them about thousands of dollars of cash income. The CPA prepares a return that, on its face, appears correct, but it is based on incomplete information. If this is discovered, the taxpayer cannot blame the preparer. The responsibility for omitting the income rests solely with the taxpayer who concealed it. In rarer, more serious cases, a taxpayer might find an unethical preparer who is willing to participate in the fraud by inventing deductions or hiding income. This is a criminal conspiracy, and the IRS has a dedicated program for investigating and prosecuting fraudulent tax preparers. A reputable professional will help you avoid taxes legally. They will never agree to help you evade them illegally. In summary, tax professionals like CPAs, enrolled agents, and attorneys can be invaluable partners in navigating the tax system correctly and efficiently. But they are not a substitute for your own responsibility. The law is clear. Your tax return is your return, and you alone are accountable for its honesty and accuracy. In our next chapter, we will delve into the psychology of taxes. We'll explore why most people comply with the law and examine the common, flawed rationalizations that people use to justify the decision to cross the line into tax evasion. Welcome back to Tax Evasion versus Tax Avoidance. For 13 chapters, we have focused on the legal, procedural, and financial aspects of the U.S. tax system. We've defined the bright line between avoidance and evasion. Today we're going to explore something different, but just as important: the psychology of that line. We're going to look at the why. Why do the vast majority of people willingly comply with tax laws? And what are the flawed rationalizations that lead some to cross over into dangerous territory? As we delve into these concepts, please remember our disclaimer. This is a general discussion for educational purposes and is not a professional psychological or ethical analysis. It is an exploration of common themes related to tax compliance. First, let's consider the positive side. Why do most people pay their taxes honestly? The U.S. has what is called a voluntary compliance system, and for the most part it works. The reasons are multifaceted. For many, it's a sense of civic duty and a belief in the social contract. People understand on a fundamental level that taxes are the price we pay for a civilized society. The money funds our military, paves our roads, supports our schools, and provides a safety net for the vulnerable. Paying your fair share is seen as a moral and patriotic obligation. Another powerful motivator is a perception of fairness. People are far more likely to comply with the law when they believe that the system is generally fair and that others, especially the wealthy and powerful, are also paying their share. This belief in procedural fairness helps maintain the integrity of the entire system. Of course, a rational fear of the consequences, which we've discussed at length in this series, is a significant factor. The threat of an audit, steep financial penalties, and in the most serious cases, criminal prosecution serves as a powerful deterrent. For most people, the potential reward from cheating on their taxes is simply not worth the immense risk to their finances, reputation, and freedom. But what about those who decide to cross the line? Tax evasion rarely begins with a cold, calculated decision to commit a felony. It often starts with a series of justifications and rationalizations that are used to make an illegal act seem acceptable. Let's examine a few of the most common ones. One popular rationalization is, "The government just wastes my money anyway." This is a protest argument. However, a taxpayer's personal disapproval of government spending is not a legal defense for tax evasion. The legal obligation to pay tax is entirely separate from the political process of deciding how that tax revenue is spent. Another is, "Everybody does it." This attempts to normalize the behavior. But this justification is factually wrong. Data consistently shows that the vast majority of taxes owed are paid voluntarily and on time. Furthermore, the illegal actions of others never serve as a legal excuse for your own. Some people tell themselves, "I'm just a small fish, the IRS only cares about the big guys." This is a dangerous miscalculation. While the IRS does dedicate significant resources to high-income noncompliance, its automated computer systems are incredibly effective at flagging discrepancies at all income levels. To serve as a public deterrent, The government makes a point of prosecuting average citizens to show that no one is too small to get caught. A particularly common starting point for evasion is the thought, it's just a little bit of cash under the table. This is an attempt to minimize the act, but it is a legal fiction. The law is clear that all income from all sources is taxable unless specifically excluded. Deliberately failing to report that income, no matter the amount, is the legal definition of tax evasion. At its core, the psychology of the tax avoider and the tax evader are fundamentally different. The person practicing tax avoidance operates within the system. They may dislike paying taxes, but they accept their legal obligation. Their mindset is one of strategic compliance. The person who practices tax evasion has made a psychological break. They have rejected their legal obligation and have constructed a narrative, a set of rationalizations, to justify that decision. It is a choice to operate outside the rules that bind everyone else. In summary, tax compliance is upheld by a powerful combination of moral duty, a desire for fairness, and a healthy respect for the consequences. Tax evasion, conversely, is often born from a flawed and self-serving psychology that seeks to justify an illegal act. In our final chapter, we will bring all these threads together. We'll provide a concluding summary of the critical differences between avoidance and evasion, and offer some final thoughts on why respecting the bright line is essential for a fair and functional society. Welcome, for the final time, to Tax Evasion versus Tax Avoidance, the critical legal line in the U.S. Over the past 14 chapters, we have journeyed through the complexities of the U.S. tax code with a single, guiding purpose: to illuminate the clear and critical distinction that separates the legal and encouraged practice of tax avoidance from the illegal and punished crime of tax evasion. In this concluding chapter, we will summarize the most important lessons and reflect on why this bright line matters not just to us as individuals, but to the nation as a whole. As we conclude, we offer our final disclaimer. This entire series has been for educational and informational purposes only. It is not, and has never been intended as, a substitute for professional legal, financial, or tax advice. We hope this series has empowered you with knowledge, but for guidance on your specific circumstances, the counsel of a qualified professional remains essential. Let us return to the fundamental concept where we began. Tax avoidance is the legal art and science of arranging your financial affairs to pay no more tax than what the law requires. It is built on a foundation of knowledge, meticulous record-keeping, and transparency. When you contribute to a retirement account, claim a tax credit for education, or deduct legitimate business expenses, you are practicing tax avoidance. You are using the tax code exactly as it was designed, as a tool of public policy filled with incentives that encourage certain behaviors. Tax evasion, in stark contrast, is the illegal act of willfully deceiving the government to pay less tax. It is a practice built on concealment, lies, and fraud. Hiding cash income, inventing deductions, falsifying documents. These are the hallmarks of evasion. It is not a strategy, it is a crime. Throughout this series, we've emphasized that the core difference between these two paths is intent. Avoidance is the intent to skillfully follow the law. Evasion is the willful intent to break it. As we've seen, this single distinction in intent leads to dramatically different outcomes. The path of avoidance is one of compliance and responsible financial planning. The path of evasion leads to audits, staggering civil penalties that can reach 75% of the tax owed, and in the most serious cases, a felony conviction that carries the potential for federal prison time. We learned that the ultimate responsibility for the honesty of a tax return rests with the person who signs it, regardless of whether a professional prepared it. We learned that the bedrock of good tax compliance is the diligent and honest paper trail. The records that prove the facts and figures on your return are true. But why does respecting this line matter so much? On an individual level, the answer is clear. It protects your finances, your reputation, and your freedom. But on a broader level, it is essential for the functioning of our entire society. Our system relies on voluntary compliance. When people choose to evade their tax obligations, they are not just taking from the government. They are stealing from their fellow citizens. They starve the public treasury of the funds needed for everything we depend on, from safe roads and strong defense to scientific research and social safety nets. Even more, it erodes the principle of fairness. When honest taxpayers see others cheating the system and getting away with it, it damages their trust and faith in that system. It creates a sense that the rules don't apply to everyone, and it unfairly shifts the financial burden onto those who are doing the right thing. The bright line between tax avoidance and tax evasion, therefore, is more than just a legal concept. It is a pillar of our social contract. It is a shared understanding that we will all play by the same set of rules, contributing our legally required share to the common good. In conclusion, the U.S. tax code may be complex, but the principle that separates legality from illegality is simple. It is the line between transparency and deception, between strategy and fraud, between honesty and willfulness. Approaching your tax obligations with diligence, and always seeking to stay on the right side of that line, is a hallmark of responsible citizenship. Thank you for joining us on this journey.
Disclaimer: this video is for informational and educational purposes only, and should not be considered professional legal, financial, or tax advice. I am not a certified public accountant, CPA, or a tax attorney. You should consult with a qualified professional for advice tailored to your individual situation. Tax laws are complex and subject to change. The creator of this video or the channel will not be held liable for any actions taken based on the information provided.